Welcome back to the SAT System channel. In this episode, we're talking about volatility, the up and down swings of the market. Many new investors fear volatility, but in reality, it's not just risk. It's also a powerful tool. If you learn to understand it, volatility can reveal where the opportunities are. What is volatility really? Volatility is a measure of how much an asset's price fluctuates over time. Higher volatility means bigger swings, both up and down. Low volatility means steadier, smaller moves. A volatile stock might swing up or down by double digits in a short period, while a stable asset like bond may barely budge. Why some assets are more volatile? Volatility is energy. It's the market showing interest, excitement, and potential growth. Without volatility, there's no opportunity for outsized returns. Smaller market cap/emerging assets. It takes less capital to move the price, so they tend to swing more. Higher trading volume, liquidity dynamics. More frequent trading amplifies reactions to news or sentiment. Market sentiment and speculation. Trending assets draw hype, causing exaggerated moves both directions. Volatility as a tool, not a threat. Many people panic when they see sharp drops. But seasoned investors view volatility differently. It highlights market trends. Assets with rising volatility are often where the innovation or capital is flowing. It creates entry points. Dips caused by volatility can be opportunities to buy good assets at lower prices. It signals growth potential. Historically, assets with higher volatility, like Bitcoin or fast-growing tech stocks, have outperformed safer, slower-moving investments over time. Comparing growth and volatility, 5-year perspective. Real estate, VNQ, up plus 17% in the last 5 years. Very low volatility, steady growth with cash flow through rents and dividends, making it more about stability, money storage than growth. Gold, GLD, roughly doubled, up plus 102%. A classic safe haven asset, low volatility, but also limited growth. S&P 500, SPY, up 101%. Much steadier growth, doubling over 5 years. Bitcoin, BTC, up more than 928%. Extremely volatile, huge swings, but long-term holders were rewarded with massive gains. NVIDIA, NVDA, up plus 1,264% in 5 years. Extremely volatile, but that volatility was the price of explosive AI-driven growth. Interpretation and caveats. Notice how Bitcoin and NVIDIA deliver far higher returns, but with far higher volatility and risk. SPY, the S&P 500, shows steadier, more predictable gains, though not immune to large drops. Gold and real estate move more slowly, offering stability or income rather than explosive growth. Past performance does not guarantee future results. These are examples, not promises. What volatility tells us? High volatility equals high market attention and opportunity. Where people believe big gains are possible, volatility follows. Stability equals foundation and anchor. Lower volatility assets help cushion portfolios during downturns. Mixing them is powerful. You don't have to go all in on volatility. Combining high and low volatility assets can balance your risk and reward. Lesson: higher volatility assets delivered explosive growth. Lower volatility assets preserved value and provided stability. A strong portfolio blends both. How to overcome fear of volatility. For many new investors, the hardest part isn't the market itself. It's handling emotions that come with price swings. The real danger isn't volatility, but making impulsive decisions. Here are proven tools to manage it. Dollar cost averaging. In long-term investing, commit to putting in a fixed amount regularly. Volatility becomes your lie. You automatically buy more when prices are low and less when prices are high. Stop loss and trailing orders. For short-term trades or higher-risk assets, use stop loss or trailing stop orders. These automatically sell when prices fall past your chosen level, limiting downside risk without constant monitoring. Hedging with stable assets. Balance your portfolio with safer assets such as gold, bonds, or real estate. They provide stability when stocks or crypto are volatile. Think long-term. As investor Ken Fisher said, time in the market is more important than timing the market. Stay focused on the bigger picture and don't let short-term swings push you off course. The hidden risk of cash. Many people believe that keeping a lot of money in the bank or in cash is the safest move. In reality, it's the riskiest way to protect value. Why? Because inflation and currency debasement steadily erode purchasing power. Holding too much cash is a guaranteed way to lose quietly, year after year. Investing, even in lower volatility assets, gives you the chance to at least keep pace with inflation and protect your wealth. Key takeaway: volatility is not something to run from. It's something to learn from. The fastest growing assets are often the most volatile. By understanding market trends and combining high volatility growth assets with stable, low volatility anchors, you can build a portfolio that grows faster without losing balance. So next time you see Bitcoin swinging 10% a day or NVDA doubling in a year, you will understand that is the volatility pulse of growth. But also remember the role of gold, real estate, or broad indices as stabilizers. Conclusion: volatility equals energy. It is the heartbeat of the market. Instead of fearing it, learn to read it, respect it, and use it to your advantage. Good assets with higher volatility often grow faster. Safe assets with low volatility keep you balanced. Together, they build the foundation of long-term investing success. For daily briefs and analysis across macroeconomics, real estate, stocks, crypto, and digital intelligence, visit satsystem.com. If this helped you see volatility in a new light, make sure to subscribe and join us.